Story today, fewer job cuts in today's ADP report, clearly behind some of the advance on Wall Street. Question is, are we going to see similar optimism when we get the employment report for the last month? That comes out on Friday, and might we see a big rally for the market as a result of that? Joining me now to talk more about that is Lee Munson, Chief Investment Officer at Portfolio Asset Management, along with Scott Wren, Senior Equity Strategist with Wells Fargo Advisors. Gentlemen, nice to have you on the program.
Thanks, Maria.
Let me first get your take on what we might expect out of the employment report on Friday. Are you expecting a tough number in terms of job cuts and the unemployment rate, Lee?
I'm not expecting really great news, and I think that right now the market isn't really moving off the news. I think that what we have is a lot of momentum. I think this momentum is starting to burn down, and I think what we really want to see is, whether it's good news or bad news, is whether the market keeps reacting in this upward swing. So I'd say right now I'd want to be a little bit more cautious and take some money off the table.
Scott, the estimates are for a loss in jobs for the month of 628,000. That is the estimate on the job cuts for the last month. And we've been going along this trend of 500 to 600,000 jobs lost every month. Do you think that's priced into the market?
I think it is, Maria. As a matter of fact, I think everybody expects the unemployment rate to inch higher. Tomorrow the consensus is at 8.9%. I think most people think we're going to see it at least a bit over 9%. So if it came in a little bit higher than 8.9% tomorrow, I don't think that's really going to be much of a surprise. We'd love to see that surprise if it came in at 8.7, 8.6, something like that. That's where the market would get an additional kick, I think.
Does it matter to you in terms of investing? Tell me how to invest in this environment if, in fact, we were to see that.
Well, of course, we're trying to look ahead, and in our opinion, you're going to see positive GDP in the fourth quarter. You're going to see positive earnings comparisons in the fourth quarter. So we've been trying to get our clients over the last 6 months or a little bit more than that to reduce those healthcare, utility, staples positions, those defensive positions, get into increase these consumer discretionary positions, industrials, air freight and logistics, construction and farm equipment, those kinds of things. That's where the earnings growth is going to be. I think right now the market is just happy with the vision that, hey, we're going to see some stabilization here. We're seeing news that is still bad, but it's less bad than the prior month.
Lee, do you agree with that? Financials have already had a big run. You want to be you want to be buying?
No, we're net short financials. We pressed our bet. We're all in on SKF today ahead of the news that we're going to see tomorrow. I think this is overextended. Even Bernanke said in his comments this week, everything is based on the financials recovering, and we don't see it. We think that all these leaks with the bank stress tests, we think it's gaming the market. We would rather be short right now financials. The thing that we really have passion about being short is the retail sector. I think that regardless of what unemployment is going to be, the retail sector is very overextended. We took out some more stock in Pepsi today. We're still long Unilever. So we're not ready to give up on those staples and these defensive names right now. The bottom line is that everything in the fourth quarter, which is what Scott's talking about, is all dependent on these financials recovering, and we don't see it. We're betting against what the common notion is right now.
Because they will need more money, or they won't be able to sell the toxic assets, or what?
Yeah, I think the toxic assets are going to be a big issue. I think that, we've seen a lack of secondary offerings on the table. Goldman's done it, but I'd like to see some more secondary offerings to see if we're going to dilute that. And I also think that, they're just not lending. I think we're just going to have a slower recovery. I still say it's going to be early to mid 2010, and we're in the May to November season right now. It's not a great time statistically for the market. So we are more long right now than we ever have. We're about 60% long, but we also have 20% of the portfolio short, but specifically in the retail and the financial area. With that news from Cisco today, we have covered our shorts, and we don't want to get in front of technology right now. We still think that has a way to go.
All right, we'll leave it there. Gentlemen, great conversation. Thanks very much.
All right, thanks, Maria.
We'll see you soon.
Thank you.
Tomorrow, meanwhile, AIG expected to post a first